Hey guys, welcome back to the channel. It's Liquid here, and today I'm going to show you how I trade options. Specifically, I'll demonstrate my process for selling put options using my brokerage account with Interactive Brokers. I've only started trading options since April, but so far I've learned a lot, and I believe I can consistently make about $1,000 a month from this side hustle. So by the end of this video, you'll get a pretty good sense of how I research my options, how I choose the strike price, and how I reduce my risk. This option strategy that I use has a high probability of success. It also takes a conservative approach to risk and has a margin of safety built in. Okay, so let's get into it. This trade actually took place last month, so let's take a look at the pre-recording I made. Okay, so today is Friday, June the 4th, and I usually like to start with Yahoo Finance just to get a feel of what the market is doing and what stocks have been doing lately. So I want to start by taking a look at Mastercard and Visa today. These are large blue chip companies that have been around for a very long time. So Visa has been going up over the last year. That's a good sign. It's a bullish trend, something favorable for selling options. And Mastercard, same kind of thing, very nice. So I chose these two stocks because even if they fall a lot, I'm okay owning them. So next I will go to barchart.com, and this kind of gives me an idea of how volatile each stock is. So Visa has an implied volatility of 20%. So the higher this number is, the more fluctuations you can expect in the price, and usually the higher the premium is for when you sell options on it. So I usually want this to be a high percentage, above 10 or 20%. So Visa's at 20% and MasterCard is at 23%. So I'll probably sell an option for MasterCard right now just because it has a higher implied volatility and both have relatively the same risk profile, but I can earn a little bit more money from MasterCard. So the next thing I do is some fundamental analysis on the actual company itself, like what the earnings are, is it growing its business, what are analysts saying about it. So on Yahoo Finance, you can see that 1-year price target is much higher than its current price, so that's a good sign. So out of 37 analysts, the most pessimistic one thinks that in a year from now, MasterCard will be at $370, which is even higher than today's price. So that kind of shows analysts are very bullish about the stock. So it has a really good chance of going up, they think. So I would be okay selling an option on this because when you sell an option, you want to do it on a stock that you are bullish on. So for those who don't know, an option is a contract that allows you to trade a stock at a specific price. And of course, this is useful if you want some downside protection for your stock holdings. Let's say you own a stock right now and it's trading at $100, and maybe you're afraid that it'll fall over the next couple of months. But you also don't want to sell, in case your stock goes up. So what you can do is buy a put option with a strike price of, let's say, $80. This way you can sell your shares at $80 if you want to, if the stock price drops a lot. Even if the stock falls to zero, you can still just sell it at $80. So the most you can ever lose is 20% from where the stock is today. And just like the milk in your fridge, every option contract has an expiration date. So you can't exercise your trade anymore after it expires. So it's kind of like buying insurance, which sounds pretty good. But of course you have to pay a price to own this option, just like any insurance. And the price that you pay is called an option premium. And this is where option sellers like myself come into the picture. My entire option strategy at the moment is basically collecting the premiums by selling put options to those who want to buy them. The more volatile a stock is expected to be, the higher the premium I can make. So if I go back to bar chart here, you can see I have calls on one side, puts on the other. So the next thing I want to do is figure out what strike price I want to sell the option at, and also when is the expiration. So by default, it's just setting it to the closest date, but I want to choose something usually 1 month or 2 months out. So I'm going to choose July, and it tells me I have 42 days until the July expiration. So that's a good expiration date for now. So to help me figure out what is the best strike price, I'm going to use this spreadsheet here, and I can just input in some numbers and it'll tell me what is the strike price at 1 standard deviation away from the mean and 2 standard deviations, etc. So this follows the normal distribution curve, which basically says that if you're one standard deviation away from the mean, then that roughly represents 68% of the area, or 68% of the chance that it'll hit uh, that particular range. If you go two standard deviations out, then you're looking at a 95% probability of getting somewhere within that range. So that's important to keep in mind, because if you choose a standard deviation that's too close to the mean, then you have a higher chance of getting it assigned, which is not the ideal situation. So in terms of this Mastercard options trade, I'm 42 days away from expiration, and the implied volatility is 23. So I'm going to go in here and punch in those values. And that's the current stock price. And these are the range of strike prices that I can consider. So I don't have to choose like a particular one, but these are just good to keep in mind. So depending on what kind of stock or fund I'm trading options for, but generally I stay around the 2 standard deviation point. So in this case, $307. I can go a little bit higher or a little bit lower, but that is a good balance between not getting it assigned. So I'm going to have a 95% chance of success, but also the premium will be pretty decent around there. So I'm going to be looking at around that strike price. So back to bar charts now, I can find the strike here, and I'm going to look on the put side. I'm going to go down to about 306, which is here. And you can see the delta, this number here, it kind of gives you a rough idea of what is the chance of this being assigned. So that's about a 6% chance of it being assigned. That's about 5% chance. So at this level, I can expect to earn about $1. Multiply that by 100 because there's 100 shares per option. And so it's about $100 in premium. So now I'm going to open up my Trader Workstation, which is a trading tool from Interactive Brokers, the discount brokerage that I use. And I'm going to type in Mastercard here. So that's the current, this is for the stock. And I'm going to bring up the table for the options. And I'm going to choose the date of expiration to July 16th, which is what I'm looking at, 42 days from expiration. And the deeper the blue, the more in the money you are. So if I go like higher up, you can see it gets more grayed out here. I'm looking at somewhere between these two, right? So somewhere around this area. It doesn't have to be exactly these two. I'm also looking at the option open interest. So the higher the number here, the more likely it'll go through. There's more volume. So I think 310 is looking like a good strike price. It's higher than 305, but I get quite a bit more premium than 305, and it's only $5 more on the stock. So I'm just paying $5 more for the stock if it gets assigned. So I think that's a good trade-off. I'm just going to double check on Yahoo Finance again, just the chart, and just do like a quick technical breakdown. I can basically look at this chart and think, where can this stock price go? And I can use the previous lows here as sort of support indicators. So this one's at 316, this one's at 288. So there is a chance it could fall, it could fall to anything. But in terms of expectations, I would assume it would stay above this point here over the next 1.5 months. And even if it drops like really low, like here, you can see how before it just bounced right back up. So I'm not too concerned about hitting that point. So I think 310 around here, that seems to be a good price. It's right around the bottom of the Bollinger Bands. So back to the trading platform here, I'm going to choose the 310 and I'm going to click on this 94 cents bid, and that's going to take me over here where it shows sort of like a summary of what I'm doing. I want to sell the put, one quantity, that's enough. If I want to have this order filled quickly, I would stay closer to the bid. If I'm patient and I don't mind waiting, but it might not get filled, I can go closer to the ask. So my limit price, let's go with $1 for now, and I'm gonna submit this.
Order filled.
And it looks like it filled, so that's good. I probably should have went higher though. So right away in my trades, it's going to say I sold one Mastercard put for July 16th, and I got credited basically $101. So the next one I'm going to look at an ETF. It's QQQ, which basically tracks the NASDAQ 100. So this is an ETF, so it's not an individual stock, which means there's virtually no risk of this going to zero. And if I believe technology stocks will do okay, trend line looks good, and I don't mind owning this long term, then I can write an option for this as well. So I'm going to click on this graph, go in here, and so the bottom of the Bollinger Band here is around 300. So that's something to keep in mind when I choose my strike price. So in bar chart, I'm going to load up QQQ, and so it has an implied volatility of 17. This is a bit lower than what it is historically, but that should be fine. I'm going to choose again July the 16th, which is 42 days away from expiry. So pulling up my calculator again, 17.7, still 42 days out, just rounds it to 18. And at 2 standard deviations, it's at $295. So again, 2 standard deviation is usually what I use, and I try to pick numbers around that figure. So here we see a table of very granular strike prices. So you can see here at $293, it's already 2 standard deviations away from the mean. So I'm looking at, so this is all within 2 to 3 standard deviations. And so at 290 here, 2.2 standard deviations, 289, 288. So this is at 2.3. So I probably want to go with a 290. So I'm still more than 2 standard deviations away, which is pretty safe, but I can get a pretty good income here. And it seems like a pretty tight spread here. So it should be filled with a relatively predictable price. So again, I'll just click on the bid number here. Set my bid here. I'm going to set it on the high side here, 113, and see if it fills. Because if the price of this option goes up, then these bids and asks also will go up. And I'm going to submit. I'm going to make after commissions about $112. So the order has been put in, and it has not been filled yet. Quantity 0 out of 1. So I'm just going to wait a bit and see what happens with that.
Order filled.
Oh, that looks like it just filled. So if I go back here, you can see the order has been filled at 113, and I didn't have to wait too long. And now I just wait until the option expires. So let's fast forward into the future. Hello again. Today is Saturday, July 17th, which means the 2 options that I sold last month have now expired, and we can take a look at what happened to them. So Mastercard, last close yesterday, Friday. Take a look at the chart here. So on June the 4th, which was here, I sold a put option with a strike price of 310. And by the end of the expiration date yesterday, Mastercard is trading at 387, so that's much higher than my strike price, which means I am way out of the money, even more than before. I'm going to jump over to QQQ, and it's a similar situation here. June 4th, this is when I sold the option, and the stock went up, and it expired yesterday out of the money at 357. So here's a look at my options trade inside Interactive Brokers. This is just a breakdown of what happened and the overall transactions. So on June 4th, I sold a Mastercard put option, -1 here because I sold short for $1.01. There is 100 shares per options contract, so the total is $101, -76 cents for commissions. And so I ended up with $100.24. And then yesterday, the option expired, +1, so these two cancel each other out, which means I don't have a position in this anymore. Since I didn't close out my position early or buy the option back, there was no other transactions, so my total profit is $100.24. This is the column for realized profit loss. And if we go to QQQ, June 4th, sold it, made some money, and yesterday it expired at 4:20. So overall $212 for maybe 10-15 minutes of researching and conducting the trades for these two options. And as you can see, like over the last month, I've done a bunch of other put options as well, most of them just selling puts. The P here stands for put. So if you want to follow my other trades, I post monthly options trading updates on my blog. You can just read those articles, and I sometimes go into details, breaking them down, kind of like what I'm doing with this video here. So as you probably figured out by now, it's important to only use this strategy on strong blue chip companies or index funds that you don't mind owning long term. Of course, there's a lot more that goes into the decision-making process when trading options, and I'd be happy to dive deeper into those topics in another video. So if you want to see more content on options trading, give this video a thumbs up so I'll know to share more of my progress in future uploads. So there you have it, selling put options with interactive brokers to make some side income. I'm certainly not an expert in this, so please don't take any of this as advice or anything. I'm just simply sharing my experience and just showing my thought process behind how I trade options. Of course, I'm also continuing to learn as I go, so if you have any feedback or ideas, let me know. Hopefully you found this video to be useful on your financial journey. So happy investing, and until next time.